Hey guys, good morning.
Good morning.
Fancy new intro there, huh?
It's pretty rad.
Yeah, for sure. So, with that intro, I'm going to jump us right in this week instead of our witty banter. So, I want to welcome all of our viewers to our DAT IQ weekly market update. This is our update for November 17th, 2020. I'm Ken Animo, Chief of Analytics at DAT, and Ned, our principal data scientist, has returned to greet us with his presence this week.
Thank
and
you.
we have Dean Croak, our principal industry analyst. So, week before Thanksgiving, guys, how you holding up?
Couldn't be better. Happy to be here.
Thanksgiving's a little contentious in my household. My wife doesn't eat meat, and so it's good. I've gotten used to it over the years, but it's a little different.
Tofurkey. Do you make both, or do you just have like a tofurkey?
Normally we make both, but this year we're just going to do tofurkey because I'm the only meat eater who's going to be at the house. So,
my condolences. I'm officially in flannel season. I'm leading up to deer season, deer hunting season here in the Northeast. So it's flannel from here on out.
Yep.
All right. So as we do every week, we're here every week Tuesday morning, 10 Eastern, 7 Pacific, talk about freight market trends and the ins and outs of the markets. We're going to run through some key points of the week. Dean's going to take us through a market update. We have our long-term forecasts as promised for both spot and contract, van and reefer. And then we're going to get to some user questions. So if you have any questions from our viewers, whether you're on YouTube or LinkedIn, please drop them in the comment or chat and we'll be sure to get to them. But with that, I'm going to jump into our key points of the week because we have some really great data this week. So things that we're watching. Total load posts were down and truckload searches up. This is an interesting trend Dean's going to go through. It kind of raised a lot of eyebrows when we were looking at it this week. Reefer capacity is tight, but seasonally expected. So a really healthy uptick in reefer rates, and we're going to get more into that. I think the story nationwide, not just in freight, but general news media, COVID cases beginning to impact some markets. And then this digital commerce shift appears more and more to be permanent. So turn it over to Dean to walk us through our market dynamics and rate update.
Yeah, thanks, Ken. Some of those key points are evident as we look at our market update this week, in particular load posts and truck search volumes. Starting off with the dry van sector, load posts dropped 10% last week, which was kind of unusual for this time of the year. A lot of that freight is already in markets, as we'll explore in a second. 6% more dry van trucks posted for loads last week, so a slight easing capacity. As a result, the dry van load-to-truck ratio dropped to 4.20, but tracking seasonally with 2017. Very similar pattern in load board activity in the refrigerated sector, although load posts decreased less than dry van. They only dropped by 4%. And 3% more trucks posted for loads. The combined effect was the load-to-truck ratio dropped about 13% to 9.87, but again, tracking closely with 2017. Same in flatbed, very close to 2017 load-to-truck ratio. Volumes are down seasonally, 7% last week. That's the 9th week in succession that load posts in flatbed have been declining. Capacity loosened also. 9% more trucks posted for loads last week, so there's a definite cooling in that market. The load-to-truck ratio dropped to 28.61, and again, no great surprises there from a seasonality perspective in flatbed. Looking at the market condition index, and this picks up on some of the points Ken was talking about. If we go back to late September, we saw a surge of exports from China that made their way to the West Coast and East Coast. There was a record volume of imports. Volumes are up 50%, 52% in fact, month over month in Los Angeles on the outbound load post side. And what we're seeing though this week, some weeks later, is that ripple effect across the country as volumes work their way into all of the large established warehouse markets. And interestingly, recently developed micro pop-up fulfillment centers that we're seeing addressing this immediate need for e-commerce freight. So if we follow that thread, volumes dropped again last week in Los Angeles after being up significantly in October. They were down 13% week over week. And that freight flowed inland to logistics hubs like Memphis, where volumes were up 15% week over week. Memphis capacity loosened a little bit. Rates dropped to $254 a mile after being tight for most of October. Another another warehouse market further north in Columbus. Volumes are up 6% week over week. But unlike Memphis, capacity was significantly tighter. Rates are up around $262 a mile. Now, if we look at our top 10 markets, it's interesting that Memphis and Columbus were the only two markets to post gains last week in the top 10. Every other market posted significant decreases. In the refrigerated sector, we're still seeing fall truckload produce volumes impact the market. They're down 17% week over week compared to 2019. That's significant. That's about 8,000 fewer truckloads compared to last year, but that's been offset by a substantial increase in frozen foods during the pandemic. According to the American Frozen Food Institute, frozen food sales are up 94% since March. Now, locally, demand for Christmas trees, potatoes, pears, onions, and apples are keeping brokers very busy in the Twin Falls market in the Pacific Northwest. Twin Falls took #1 position last week for outbound load posts for the first time this year, pushing out Los Angeles, Ontario, and Atlanta. Volumes are up 13%. Capacity is still really tight. Rates have risen for the fourth week in succession out of Twin Falls, up 11 cents to $269. Capacity is also really tight in the Midwest. Green Bay, lots of fall season potato volumes are moving. Market volumes are up 5% week over week, and spot rates are up 11 cents a mile also to $3.43 per mile, excluding the fuel surcharge. In flatbed, load post volumes in the top 10 markets decreased again. They've been doing that for the last few weeks, down 7% week over week. Seasonally, it's important to note that a cooling in the flatbed sector as ambient temperatures drop and building and construction slows above the I-40 line is seasonally on track for this time of the year. Significantly, volumes in our #1 market, Little Rock, plummeted 26% last week, following notable declines also in the Pacific Northwest markets, Spokane, Medford, Portland, all were down about 12% combined. So wrapping up with our dry van spot rates year over year view, very little movement, some upward movement in dry van rates last week, but they ended up settling around $227 a mile. Rates are still up 50% year over year compared to the same week last year when rates were $1.51 a mile. They're up 76 cents per mile this week. The chart kind of caught my attention this morning when you look at that massive red line there. It highlights this 200-day upward increase in rates that we've had since May 1st when the demand crashed. It's 200 days of upward rate pressure, up 95 cents a mile from May 1st to this week. And that's kind of been the story of this year in terms of spot rate movement. In the refrigerated side, pre-Thanksgiving freight volumes, again, seasonal, fresh turkeys, late season produce kept volumes from dipping as much as they did in dry van. But what's important to note is that much of the poultry and produce volumes are very regional, i.e. they're not in large cities. So capacity remained very tight with spot rates inching up 3 cents a mile to $2.51, excluding fuel surcharge. Similar to dry van, rates are up 68 cents a mile compared to the same week in 2019. And lastly, in flatbed, rates in the flatbed sector have been plateauing for the last 9 weeks around the 220 miler mark. No evidence of upward rate pressure after 3 weeks of decreasing load volumes. Again, compared to last year, rates are up 45 cents a mile in the flatbed sector when they were $1.75 a mile. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to DAT/resources and download the market update. So that's it, Ned. Over to you for the rate forecast.
Thank you very much. So this week we're going to be doing something a little different. We're going to be looking at the long-term forecast. So the first long-term forecast that we have is for spot rate on the reefer side. You can see the blue line is the market rate as observed by DAT. The shaded region is the year-over-year variance. So that point's variance compared to the prior year. And then off to the right, you can see we're just using one model because the short-term model isn't really applicable for long-term forecasting. And here you can see we have kind of 3 different levels that are all going to be the same pattern because they're coming out of the same model, but we have kind of like a high confident, a bullish take, a moderate take, and a bearish take. And you can see—
Ned, just to level set for viewers that aren't as familiar with this, the high and low correspond to our historic model accuracy, right? Projected forward.
Yes. Yes.
Okay. Thank you.
Yes. No. Thank you for clarifying that, Ken. The green line again being our kind of upper bound, the red line being our lower bound, and the blue line being the kind of central point. Here you can see that we're expecting rates to drop going into the early part of next year and then probably level off and maybe tick a little bit back up. Obviously, these are contingent on kind of business as usual keeping pace. If there are big changes as a result of, for example, additional waves of COVID activity or other things like that, then these forecasts will become less reliable. Moving forward to the reefer side, same sort of a chart where you have, again, the blue, the market rates observed by DAT, the gray region being the year-over-year variance, and then the 3 lines heading off to the right. Similar sort of a pattern with a little bit less expectation of an initial drop. The initial drop will be less sharp, and then an uptick moving in following seasonal patterns going forward. Next, we have the dry van contract rates. One of the things that's both fun and annoying about working with contract rates is that they're a lot smoother than spot rates. So the smoothness makes the forecast look prettier. The smoothness also makes it a lot trickier to do kind of more simple forecasting like day of week, etc. Anyway, that's completely beside the point. But you can see the shaded region again is the year-over-year variance. The blue is the market rate as observed by DAT, and you can see that there's kind of a model consensus, or there is an expectation that contract rates are going to be rising to meet up with where spot rates have been, and there's going to be some kind of an equilibria there. Finally, we have the national reefer contract rates. You can see it again, blue are the actual market rates as observed by DAT. The gray are the year-over-year variance, and the 3 lines represent our consensus, the high end of the confidence band and the low end of the confidence band. The consensus being kind of flat with a little bit of downward tick. Reefer contract rates, obviously, although they've been affected, they've been less affected by, in just absolute terms, by the market craziness that's been going on. And so the expectation is that they will continue to be kind of muted in their effect going forward. And that's about it for the forecasts. I know that I saw somebody was really interested in looking at hotshot freight as well. Currently, we don't have a kind of fixed hotshot model, but I know that that is of interest to a lot of folks. And I think that takes us to the IQ question of the week, which is, are we heading back towards March again in the sense of states issuing new lockdowns? How will that affect freight?
You want to kick this one off, Dean?
Yeah, it feels like we had a number of discussions with folks on LinkedIn this week, and it kind of feels like March in a lot of ways, with supermarkets being somewhat preemptive. They've already introduced limitations on certain items in the stores. I've noticed it in my local supermarket, where they've started to limit the fast-moving CPG items like paper products and disinfectants and wipes. That started late last week, so I think retailers have learned some lessons from March, where they're being a little bit more preemptive. So I think they're aware of what could happen. That still doesn't stop human behaviour from restocking their pantries, but I think a lot of pantries are pretty well stocked. So retailers in general that we spoke to don't expect the surge that we had back in March on some of these fast-moving items, but nonetheless they're anticipating it could happen. So that will play a role, but it's also playing a role as the pandemic impacted markets in March, when it hits an area and the local authorities introduce restrictions to stop the spread of the virus. It impacts. I'm going to give you an example. In the dump truck space here in New England, rates have been dropping dramatically for 3 weeks, and it's largely because as soon as there's one positive case on a building site, the whole site shuts down. So building and construction is impacted. The flow-on effect is that those power units don't have work, and then they can shift into the refrigerated, dry van and flatbed sector. So I think it's having an effect at regional areas. But from a macro level, a lot of that freight that we need for sustaining ourselves, for working and living at home, is already in warehouses ready for online demand based on the stock replenishment programs we've seen from major shippers.
Yeah, I mean, I hope it's not like March for a lot of different reasons, not just freight related, right? I mean, I think the one thing you could think about is we have a lot more to lose now. I mean, there's been a lot of prolonged upward pressure in the market. We've gone through, I mean, when March hit, bids hadn't been, sent out, responded to, and contracts inked at plus 7, 10, 12, 15%. So I think there's a lot more at stake now than there would have been in March as it pertains. I think you can say that about the whole economy as well, right? I mean, the American consumer spends a lot more money in November and December than they do in March and April.
I think, Ken, we had some good news this week about vaccines too, which brings another element of optimism. And of course, you can see this pent-up demand. It kind of makes you wonder whether 2021 will just be this breakout year where all this pent-up demand drives more expenditure on services and goods from a GDP perspective. So that's a positive thing to look forward to. I fear that in the interim, we'll start to see a dip in consumption and consumer demand, and somewhat of a lull in freight demand between now and when all that positive the therapeutics and the vaccines start to take effect.
Yeah, this morning, I think if we get 20 million doses this year, that's still less than the CDC recommendation for the 5% of the population for first responders.
I think I'm in phase 4, for example. That's sort of what I'm talking.
Yeah, so would I. My wife would be in 3 because she's a teacher. Yeah. Right, so, right. Again, I think the stakes are very high. I mean, this isn't. These chess pieces are being moved. That are trillions of dollars of future GDP and lives and hundreds of thousands of lives. So, I mean, we haven't even talked about stimulus, right, as we head into 21, but that's going to be a major factor to potentially prolong this rally or even stabilize it at the higher levels that we've achieved at the end of 2020, right?
And we saw a reemergence or maybe a continuation of the long food lines in Texas this week, just to sort of magnify how hard it is for some people at the moment. Yeah.
All right, so we're going to shift over to questions. So please, everyone's been a little quiet this morning, so please send us any questions that you have or thoughts, or if you've played around with our new 3-day rates or have any questions, let us know. We have one from Peter, kind of an exasperated, based on the forecast, you guys project upward rates for dry van through 2021. He thought that rates fall after the holidays. So, Ned, do you want to take that one?
I mean, that was not what the chart showed. The
contract rates it did, right? That's the difference. So contract rates aren't as going to be seasonally affected, right? Because those rates are being layered in. They carry a lot more momentum with them, right? So contracts being signed today, that freight starts moving. It's at a higher rate. That new rate differential is a positive number, and it sort of is a slow moving upward trend. Definitely on the dry van side, you see a pretty marked borderline collapse after the holidays, and doesn't start ticking back up until like April of next year, right? Heading into seasonal time periods, but it's a pretty sharp decline.
Yes, that was exactly what I was going to echo, is that contract rates are very affected, and Chris Kaplis actually does a really bang up job with this kind of analysis where you're looking at terminating contracts versus restarting contracts, and there's this upward pressure for contracts to kind of move more towards what the spot rates are, just because the contract rates need to reflect the reality on the ground. So I wouldn't take the contract rate forecast as being indicative of what the actual market rate is going to be. The spot rate forecasts are what the market rate is going to be, or what we expect the market to be. And those, you have a very, very sharp drop is what is expected as you move into the holidays.
Right. Gamer Pro has a question. With current market rates, can we expect a drop or increase in the next couple of months, even despite the holidays? Kind of a similar question, and I think it's a tale of two markets, right? Spot and contract. I'd be extremely surprised if spot rates didn't cool. I mean, it's just kind of a known. After the return season, which is kind of stretched out into mid-January, things do. So there's just not as much stuff. People bought all their stuff. They opened all their presents. They, what is there to move? And this is a typical part, right, Dean, where LTL carriers are furloughing dock workers. I mean, things just generally slow down before the spring uptick. I think it's a fallacy. You see like an annual OR number for a big asset carrier, and you assume they're running at 85 every month. It's really not the case, right? Those things stretch and contract, and good months, bad months, et cetera, et cetera.
Yeah, I agree.
We have a question from Jack Winstead from Uber Freight. Are 3 dates going to be available via API, or are they already available via API? I know that they ought to be available via API in the future. I don't know if they're available via API now. Do you know, Ken?
We will have to check with our product folks, but we will get back to you on that one. That's a great question.
I know that data.
We'll have an answer for you.
Oh, sorry.
What's that?
I was going to say that regardless of what the answer is, data analytic services are definitely going to be able to get that data to you. DAT data analytic services.
Yeah, we can deliver that through our what I call like the Etsy of our analytics. It rolls up under my organization. But yeah, we're seeing it. I was hoping to have a number. We didn't quite get it. Everyone's, I think, a little. I'm on my third round of allergies, as you can probably tell, but I think everyone's been a little lethargic this week, heading into the holiday. I'm curious to see. I know that we've gotten a ton of feedback on 3-day rates, and I think we should have a number next week on how many we're actually seeing ran through the machine. Yes. I wouldn't be surprised if it was in the millions. But as we head into these holidays, right, 3-day rates become ever the more important. I mean, these are, because what I'm curious about is in all your charts, Dean, it showed everything kind of happening a week to a week and a half earlier than typical.
Yep.
So what I'm wondering is, are they anticipating next week to be kind of a knockdown, drag out demand week, or kind of carriers going to pocket the money that they've been making and sort of take the week off, a much needed week off?
Yeah, I think it'll be regional, Ken. Next week, for example, is the busiest shipping week for Christmas trees. Everybody expects Christmas trees to be in the lots and stores the day after Thanksgiving or the week after Thanksgiving. So that's going to drive demand in the Pacific Northwest, Michigan, North Carolina in particular. So I think there'll be pockets of demand for carriers. You've got the summer produce season starting to come online. I know we're still in fall, but the produce season starts in the south, around now. We've got pockets in Phoenix, Arizona, where there's volumes starting to increase in the leafy green space. So I think there'll be pockets of demand that will keep carriers busy. Flatbed sector is probably the one that will fall off the most. So I think next week, looking at the way rates and demand are increasing in refrigerated, I think refrigerated will be a particularly busy week next week. Whereas dry vans should continue to decline given all of that freight's already positioned for online consumption.
Yeah, I don't know. It's a hard market to try to understand, right? I mean, between shutdowns and spot, I think if spot rates remain high, you're going to see a lot of capacity remain in service that historically probably wouldn't. So this one is definitely a Dean question, but I'll do you the favor of reading it because I don't even know. I'm not Rand McNally. From Travis, is the corridor below I-40 a better market to stay in over the next couple of months? So the corridor below I-40.
Yeah, the general rule of thumb from a trucking perspective is, when it's below 40, stay below I-40. It's kind of this line where once you get above I-40, temperatures start to get pretty cold quickly, and that'll drive refrigerated demand for protect from freeze freights throughout winter. So depending how cold it gets, there'll be pockets of demand, but generally speaking, that's sort of the dividing line. The biggest reason you focus on that is if you're moving north-south or south-north, you need to protect your diesel fuel with additives, because if you're fueling in the south with fuel that's not treated for to reduce the freezing temperature, you run into the north, you'll end up with frozen filters and fuel lines, and you'll be out of service.
We have a question from Jack. I'm not sure that we can answer that, but he's asking post-election views on stimulus and possible impact on both supply and demand spending sides.
Oh, we can answer it. I don't know if we can answer it well. I'll take a crack at it, and then we'll kind of go around the room. I think I continue to remain staunch in my opinion that 21 is going to be driven by demand behavior, not so much supply behavior. I just think it's a very similar analogy to when we think about spot versus contract markets. The contract market is so much larger than the spot market that small changes there ripple down enormous changes into the spot market, right? It's 80%, probably right now 75% of all freight moves under contract. So, I think about the health of consumer spending is going to be critically important. So I'm going to take all the politics out of it, right? So the health of consumers and consumer spending and credit card debt will remain crucially important. And I think that will be aided by stimulus. That, stimulus would be bullish to that cause. And I think bullish consumer spending outweighs any sort of incentive that new stimulus would have for truck drivers to stay sidelined. I just don't, and Dean, feel free to correct me if you disagree, but I just don't see this giant phenomena of truck drivers staying sidelined because of they're getting unemployment or stimulus checks. I'm sure it's happening. I'm sure it's a part of the market. I just don't subscribe to the theory that that's what's driving. That's the marionette thing that's pulling the strings, like the Godfather.
Yeah, I tended to disagree with that driver sitting on the couch theory even back in March because owner-operators had no problems adding capacity. In fact, most of the capacity has come from the smaller fleet sector, whereas the larger fleets, because of their hiring structure, did have difficulty. So I think anybody that's interested in making money in this spot market will be out hauling freight.
Yeah. We have a question.
Now, I do think the demand, we saw 2 really great months of Class 8 truck orders. I think we broke 40,000 the last reported month for the first time in a long time. And those 2 months combined were just huge. I think the plurality of the trailing 12 months new truck orders. So that's a supply trend that I am watching, right? To say, are we going to continue ordering trucks and trailers? And then sometime in 21, we've substantially replenished the market with power units. Now, some of that's going to be replacing old stock, or, people may have delayed, retiring an older power unit or an older trailer, right? I know for a fact, just some talking to some carriers, that some of the more strict shippers with age requirements have laxed those during COVID, right? They might say your power unit can't be more than 3 years old, or the trailer, especially a reefer trailer, can't be older than 5 years old. They may have laxed that or given like a 6-month extension just due to COVID and the availability of equipment. So I think some of that will go to replenishment, play a higher rate than average, but then I think you will start to see incrementally positive units added into the capacity pool. So for the sake of getting into more questions, we can talk about this more next week.
We have a question for Fresh. Yeah, we have a question for Fresh Air Brown. Reefer in the Northeast, how do you see it in the upcoming holiday and COVID?
It's still very tight. I think a lot of carriers have a reluctance to run into the Northeast. They pay drivers more to head up that way. You've got traffic. Weather is another big factor that truckers generally try to steer clear of. So that creates this natural imbalance in outbound loads. So right now, if you think about where rates are up about 2% week over week. They're up. They were $2.36 a mile a month ago. They're up to $2.42 a mile. So they're up about 6 cents a mile already in New England. So I expect rates to continue upward pressure in New England for refrigerated rates, largely because of the inbound imbalance. You've still got, the highest demand right now is out of Maine. But you've got to go a long way north to get refrigerated freight out of Presque Isle to run south, but those rates are pretty strong at the moment. So I expect demand to be pretty strong for refrigerated capacity southbound.
Yeah, I think that's going to be another. I mean, how does the supply and demand for reefer dynamics shift with a potential another shutdown or soft shutdown looming, right? I mean, from what I understand, a lot of the food service industry, I know they're down net, right, from 20 to 19 to 20. But a lot of them have done a pretty good job of shifting from eat-in to takeout and delivery and things like that. So I wonder how much of that is here to stay. Because I look at like some of the plateauing that we see in our long-term reefer forecast, and I wonder how much of that is just driven by that market adjusting.
I think there'll be pockets regionally, Ken, where there'll be wild swings and fluctuations in demand and rates. I mean, out of Maine, I just took a quick look in rate view. Rates are up 50 cents a mile week over week out of Maine. Southbound for refrigerated rates. So that's a substantial jump in a week. So I think you'll see that more often than not between now and the start of the new year.
Just a quick question about Maine, though. I mean, or not to go too deep into the weeds here, but Maine is like a Florida in the sense that you're really having to catch a premium because you're not able to get something back the other way. So do you think that very large variance could be driven by that in part?
Oh, sure. Yeah. You've got to run a lot of empty miles to get there. So that's part of the reason those rates are high. So that's why you'll do pretty well with rates out of there, even though volumes are have been flat for the last month. There's still demand for trucks.
All right. So moving along here, one one last question from Peter. Sorry to cut you guys off. We're just Monica, our producer's in our ear. Can we speculate on what regions will command higher rates for van in Q1? And if we can, expand a little bit on flatbed. And I'll, again, sorry to keep lobbing questions your way, Dean, but when it comes to geography and things like that, you're the resident expert.
Regionally, I think you'll see strong demand, in particular for refrigerated trailers. Dry van to a degree between now and Thanksgiving. You'll start to see a lot of fall season produce, Christmas trees in particular. Portland's the #1 state, so I think you'll see really good backhaul opportunities for carriers there. Strawberries came into season in Florida this week. They started harvesting, so you'll start to see that market swing to be less of a backhaul market. The big market that's where capacity is really tight right now are in the Carolinas, North Carolina in particular, around Charlotte, Greenville. There's a lot of demand for refrigerated capacity right there now because you've got fall season sweet potatoes and turkey volumes starting to move significantly. So again, pockets. I think flatbed will be pretty quiet nationally, even in the southeast, where building activity predominantly occurs. That'll cool off over winter significantly. So they're two areas I'm watching. They're kind of adjacent markets, but Pacific Northwest and then the southeast market for refrigerated.
Awesome. Thanks, Dean. So I'm going to wrap us up for this week. I'm going to thank everyone for joining us. I would encourage you to check out Dean's market update on our website. Also, I want to give a shout out to Chris Kaplis' Freight Vine podcast. Again, always a great listen, especially if you're interested in how procurement works and a shipper perspective. One last thing, I'm humbled to share the virtual stage tomorrow with two of the best minds in freight, Chris Pickett and Dr. Professor at Michigan State University at the TIA 3PL Extend conference. We'll be talking about freight and data and kind of shared experiences and how to demand a higher standard for your data. So with that, we will be back next week. It may be a skeleton crew. It may be Dean and I holding down the fort as we head into Thanksgiving, but we hope to see you all there. And if you're not able to show up next week, from everyone at DAT, we want to wish you a happy and safe Thanksgiving. And again, thanks for joining us this week. Talk to you later. Bye.
Bye.
Thank
all.
you.